Today, responsible lending at the crossroads. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the National Consumer Credit Protection Amendments Supporting Economic Recovery Bill 2020 is now under inquiry in the Senate. And indeed, the submissions are closed, and I've actually been reading them. I'll talk about it in a second. And the next steps will be public hearings in Canberra on the 19th of February and the 26th of February. So far, no agenda has been posted. Now, I made my own submission, as I discussed the other day, and because my submission has now been made public, I am at liberty to disclose what I said in more detail than previously. So, what I want to do today is just to update you on the status of the inquiry in terms of the submissions that have come in, and also then just go through the main arguments that I made in my submission. And I think it's worth saying up front that the submissions that did come in pretty much have fallen as expected, insofar that the nearly 83 that were submitted have tended to significantly split between those in the industry, who of course are all about arguing for less controls and swifter responses so that they can lend more effectively and more efficiently, and those with a consumer focus who are really concerned about the fact that consumer protections which were put in place post the global financial crisis will disappear, and particularly those borrowers who are less able to make coherent decisions themselves may be significantly disadvantaged as a result of that. And it's worth noting, if we go through the submissions, that there were a number of individuals, as well as organisations such as the Customer Owned Banking Association and the Australian Small Business and Family Enterprise Ombudsman, a number of financial counselling organisations, various industry bodies, lawyers, of course, as well, and a number of banks, National Australia Bank, of course, the Australian Bankers Association, and a few others too. So, including CBA there at the end and Cash Converters as item 84. And the point I want to reinforce is that the tenor of the submissions have very much been determined by whether you were looking at it from an industry perspective, who want less controls and simplicity, and by the way, being steered away from any possible class actions from poor responsible lending decisions, and those with a more consumer-centric focus that are really concerned about what may happen if the legislation is passed. So with that said, let me just rehearse what I said in my submission to the Senate review, because in a way I think what I said sums up quite nicely the perspectives that I've seen in a number of the submissions. I started by saying we welcome the opportunity to provide input into this review based on our primary consumer research and lending market analysis. Whilst we believe the narrow focus of the proposed reforms may indeed reduce certain loan approval times, the renewed focus on financial stability risk as opposed to consumer protection does not adequately reflect the unequal relationship between many borrowers and lending organisations, especially for housing credit. The current responsible lending provisions provide some important consumer protections, which will be removed under the current proposals, essentially placing significantly more responsibility on the prospective borrowers, while taking an obligation from lenders. And we note the Banking Royal Commission report firmly asserted that the responsible lending rules should remain. We agree there is no case to remove them. And then I went into the background simply by saying that Digital Finance Analytics is a boutique research and analysis firm. And we've been running rolling household and small business surveys since 2002. And we maintain a market model which examines household debt, finances, financial stress, and portfolio risks. It's a simulation of the Australian economy. And importantly, we examine debt at a household rather than individual loan level. Note that APRA only considers individual loans, not household exposure. Household debt is at a record high. We know that many households have multiple loans, and the true level of debt exposure is higher than commonly understood because it is concentrated in specific household segments and locations. One key metric we track is mortgage stress, defined in cash flow terms. Since the COVID episode started, despite all the government support and a rise in savings for some households, more than 41% of mortgage borrowing households are under financial pressure, a significant and concerning rise compared with early 2020. It's clear that households are highly leveraged to housing debt, to the detriment of the broader economy. And then I went on to say we do not propose to rehearse the history of the responsible lending provisions other than to stress their introduction post the global financial crisis when poor lending standards were rife. The meteoric rise in credit, especially for mortgage lending since then, which is placing Australian households firmly in first or second place in terms of total debt on an international basis and, of course, in the low-income environment. The RBA reports that household debt to income is 1.79 times. But this is deceiving as only 1/3 of households are borrowing. The true debt ratio is closer to 5.5 times. Today, many new loans are being approved at between 6 and 8 times income, compared with the 3 to 4 times a few years ago. Lower rates may help serviceability, but the loan capital still has to be repaid ultimately. So this is a drag anchor on the broader economy, especially at a time of limited or no income growth. Too much of the Australian economy is leveraged to housing loans. This has led to home prices rising to unacceptably high levels. A recent RBA study suggested that a 100 basis point cut in mortgage rates would lift home prices by 30% or so over 3 years. Prices, however, are already well above long-term benchmarks, and further price rises powered by larger loans will simply create yet more systemic structural risks. The Royal Commission revealed how the responsible lending standards were being evaded, with many lenders breaking their own standards in a quest to boost profit and market share. Plus, credit supply is not an issue in Australia, even under the current regime. Indeed, recent RBA data reveals strong lending for housing even now. With the current responsible lending mechanism in place, household credit is rising at an annualised rate of 3.54%, with owner-occupied loans rising at 5.58% and rising further. And in addition, the latest ABS data on new home lending also signals significant growth, so the basic thesis that loan supply is under pressure is simply not confirmed by the evidence. Yet, this is one of the justifications offered for the reforms. And then I went on to discuss the fact that the changes would put the onus on borrowers. The proposed changes would remove significant protections from prospective borrowers, in that currently lenders and brokers need to ensure that the loan is not unsuitable. This term is not clearly defined within the ASIC regime, and this has led to confusion as to how to determine suitability. After the Royal Commission, banks took additional steps to validate both income and expenditure, and the recent Westpac case revealed that lenders may use a range of averaging tools such as HEM to assess suitability. ASIC's guidance has been confusing, and the concept of not unsuitable will actually vary by the individual borrower, their needs, and degree of financial expertise. No surprise then that banks would like to have this obligation removed, and some might suggest that there has been some horse trading between lenders who might face class actions under the responsible lending obligations and the bank's recent support for households and businesses through COVID. In addition, ASIC has tended to be more consumer orientated than APRA, the latter clearly aligned to the banks and focused narrowly on financial stability. The changes as proposed would place most obligations on borrowers. Borrowers would need to make their own assessment of their ability to repay and be responsible for their presentation of material facts to the lending bank. Essentially, this tilts the responsibility from the banks to the borrowers. It also lets banks off the hook from a responsible lending perspective and provides stronger recourse to them to pursue borrowers who mislead either intentionally or unintentionally. Our key point, which seems to be lost in this debate, is there is a world of difference between lending standards from a financial stability perspective, default rates remain contained for now, and what is sensible for individual households. Through our own surveys and focus groups, we find that many households are still today being offered higher value loans than they are comfortable with, in some cases by a factor of 20 or 30%. And this is with the current responsible lending provisions in place. It is highly likely banks would lend even bigger loans post their removal. We accept that APRA has strengthened the risk guidance from a bank portfolio perspective in recent years, and brokers now have a best interest duty in terms of advice. But the lack of consumer protection, which will result from the removal of responsible lending, is likely to lead to larger loans, quicker loans, and consequently more households getting into financial difficulty. In practice, less experienced and knowledgeable consumers are most at risk. This is where financial stress is already most extreme. And it's worth recounting the consumer loan experience. We find a repeated story in our surveys. Households managed to get a large mortgage from a lender, chasing prices higher. They contributed positive between 5 and 20%, but often struggle to maintain repayments, especially if their personal circumstances change. They often will undergo several refinance transactions to reset the loan, but they will eventually decide to sell and repay the bank, sometimes benefiting from equity growth, but sometimes not. As a result, the bank gets repaid and there is no default, but the financial and personal pressures on many households are exacerbated by even the current poor lending practice. Or in other words, mortgage default is a very poor measure of the true degree of social and financial stress created by our current extreme settings, yet settings which could easily become even more extreme. So we recommend that the current responsible lending regime be maintained and indeed enhanced to remove the ambiguity currently in the regulations. Indeed, we believe there needs to be a clear consumer champion from a regulatory perspective, and APRA cannot fulfill that role. We believe the emasculation of ASIC is driven partly by a view within government that they overstep their mandate. However, the evidence from our analysis is that actually they have not gone far enough. In short, the proposed removal of responsible lending rules is not warranted. And so I ended up by concluding that the current responsible lending guidance is important and should be retained and enhanced, not removed. There is no evidence that the current requirements are limiting lending. Indeed, growth is taking off fast at the moment in response to low interest rates and rising confidence, with responsible lending clauses in place. Financial stability requirements and the protection of households from loans which are too big and demanding are two separate if connected issues. Removal of the responsible lending standards would lead to more households falling into financial and social distress, and thus these changes should not be allowed to pass. So there you have it in a nutshell. And having read a number of the other submissions, I have to say, I think I summed up the situation pretty well. I'll keep you informed over the next few weeks as this issue develops further, but this is a very, very important issue that we're dealing with, because it does, frankly, determine the future financial profile and risks amongst households in Australia. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.